Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited that you've decided to join me today. We are going to talk about the Passive Investing 101 terms, mastering the basic lingo of passive real estate. Now, if you haven't done so already, if you haven't joined us here live on Tuesdays before, we do this masterclass to help you learn the ins and outs of passive investing so you can go into your next deal with confidence. So make sure you check out passiveinvestingwithwhitney.com. There, you get access to some of our free tools to help you get started in passive investing, help you create your investor thesis in passive investing. Then you also get access to my personal schedule. So you can schedule a one-on-one call with me. We can talk about all things passive real estate, and you get access to our open deals here at passiveinvesting.com as well. So make sure to check out passiveinvestingwithwhitney.com. Now, today we are going to dive into the basic terminology that you should have as an investor. Before you dive into that first passive deal that you do. Now, here's the thing. I encourage even seasoned investors to hang with me here because we're going to master the basic lingo of passive real estate. And then we're going to build upon this after the July 4th holiday with passive investing math lingo that you need to master. So these are going to be the top 25 terms that you as a passive real estate investor need to actually, the concepts that you need to have down in order to go into your first or next deal with confidence. Now, if we haven't met already, again, my name is Whitney Elkins Hutton. This is the whole reason why I invest in passive real estate, is to be with my crazy crew here. We love traveling, playing out in nature. So this is my daughter and our pup here, who is now 80 pounds. But anyways, long story short, I started off real estate investing back in 2002, completely by accident. And then decided that I wanted to not only just do live and flipping and house hacking, that I wanted to create income, regular generated income coming in from real estate. So I transitioned and scaled up 36 single family rentals, and eventually purchased a 52 unit apartment building in partnership, and then got into larger residential real estate. And then the story just kind of snowballs from there. But really what my husband and I have been able to do is scale up a passive portfolio of over 6,500 residential units, 2,200 self-storage units, and 15 express car washes, and a myriad of other assets. But that's all in service of helping us achieve 100% control and freedom on how we spend our time. And we can actually help you do that here at PassiveInvesting.com. We have a sizable equity portfolio of 1.4 billion, strong returns to our investors, but also over 308 million deployed in our rehab wallet lending arm side of our business. So if you're looking for that stable monthly income, we can help you do that as well. Now, today we're going to talk mostly about basic terms. Okay, kind of like what is a passive real estate dictionary, if there was one available. But anything that we dive into here shouldn't be construed as financial advice, legal advice, or tax advice. So make sure you take all of this information back to your investment team before making an investment decision. Now, as I stated at the beginning here, we're going to break this up into two different sessions. The first session, we're just going to start off with like the basic lingo. Okay, we're going to have some basic definitions of like relationships, of what syndication actually are, maybe even, going through some of the legal documentations to make sure we're level set on what we're actually looking at when we're evaluating a passive deal. And then here in 2 weeks, we're going to come back together and we're going to talk about the higher level math terms. Okay, that the numbers that you should be looking at as far as returns. We're going to talk about those things that are actually not returns, but hurdles, investment hurdles. Okay, and we're going to, just kind of demystify that whole process for you. But I wanted to kick off today's basic lingo is helping people really truly understand what passive income truly is. Now, passive income, there's a couple different definitions of it. if you look at, how we're actually classifying how we earn money, I mean, the IRS would simply say that all real estate, buy and hold real estate qualifies as passive income, okay? And it receives some of the highest tax breaks. But just because you have some real estate rentals doesn't mean that your time involvement is actually passive. You might be spending quite a bit of time trying to source deals, underwrite deals, find lending on deals. Okay, so when we think about passive income, this is the first thing that I really try to help investors understand. What do we actually mean by passive? Do we mean passive in the eyes of the IRS on how it's going to get taxed? Or do we mean passive in terms of how your return on your time? Okay. Now, what we love doing here at passiveinvesting.com is helping our investors maximize both of these pillars, not only the tax advantages of investing passively, but also the time advantages of investing passively. Okay. Now, the next term here is syndication. Okay. So I wanted to make sure we touch on this because a lot of people get confused when they say, I want to do a passive real estate deal. They're like, do I do a REIT? Do I do joint venture? Like, what do I do? And then we talk about this thing, syndication. This term gets thrown into the mix, and some people kind of like their heads start spinning. They're like, syndication, am I investing in the mob? What's going on here? Syndication really just means a group of investors coming together to pool their capital jointly to purchase a large real estate property. Okay, or in this case, we're talking real estate property. Now, you can syndicate all sorts of things. Okay, it just means group investment. And if we're keeping the container around real estate, we can do this. We can syndicate real estate notes. We can syndicate a preferred equity debt position, or excuse me, not a debt position, but a preferred equity position in an asset. We can syndicate car washes. We can syndicate apartments, storage units, so much more. Okay, so syndication, this is the next term we need to master here, just means group investors. Okay. Now, this really takes us into the relationship part of thing. Okay, which side of this relationship in the syndication, where do you want to be? Do you want to be active with your time, or do you want to be passive with your time? Okay, on the active side of group syndicated investing, we've got the general partner and the operator. Okay, they are the ones sourcing the deal. Okay, they are managing the deal. They got all the time involvement invested in here. They get the people, they get the systems, they get the lending, they get the credit. Okay, all right, but they're looking for capital. All right, now then we have the passive, right? And remember, we defined passive earlier as not just about taxation, but how you spend your time. So on the active, or excuse me, on the passive side of a syndicated relationship is the limited partner, or what we call the investor. Now, this person usually brings to the table capital to place, but they do it in exchange for something, okay? Because they don't generally have the deal flow, the ability or desire, or the systems in place to manage a deal. Okay, so again, just as we're thinking about is a limited partner investor, how are we going to earn our income? All right, we think about syndication. Okay, we decide, okay, great, we're going to go into a group investment. Which side of the fence do we want to be on here in a group investment? Okay, do you want to be on the general partner side, or do you want to be on the limited partner side? Most of the people that are listening here today want to be on the limited partner side of things. Okay. The other term that I want to throw out here is leverage. Now, a lot of people think of leverage as the actual debt. That is true. We can, getting a bank loan, using other people's money to go buy real estate. That is true. But I also want to help investors understand that you're creating leverage in your real estate business whenever you use a syndication to invest, because now you're tapping into a business that already has the knowledge, the strategy, the market, the underwriting, all those systems in place. They've got that expertise and track record. They've got their team of brokers, property managers, lenders, legal accountants all built out. Okay, they already have a system in place to tap into credit and the ability to get lending. They already have a system of investors in place in order to bring in other investor capital, and they have, more importantly, the time. So this is how we can create business leverage. in our investing. All right. Now, all those terms were kind of, equated or should be like attached to like a newer investor on like, how do they actually want to get into this world of passive real estate investing? How active do they want to be? How passive do they want to be? How much leverage do they want to have? Do they want to do it themselves? Do they want to invest in somebody else? What does that relationship look like? Okay. Now, if you've made the choice that you want to get into a passive real estate deal, we need to understand these two terms, debt and equity. Now, really, debt and equity are referring to the layers of money in a deal, also known as the capital stack, okay? Stack of money. So the senior debt and mezzanine debt positions, okay, these are going to be essentially using other people's money to go buy property. These are going to be like your bank loans, okay? Your first position loan, mezzanine debt would be like your second position loan, okay? You're going to get a stable income from these type of loans, okay? But you tend to get a lower return, but lower potential risk as well. And then after that, we get into the equity position, preferred equity, common equity. Equity tends to be higher potential return, but also higher risk, right? So as an investor, you need to ask yourself, which part of the capital stack would I like to invest in, right? Do I want to be the bank, or do I want to be a business partner? If you want to be the bank, stay in debt. If you want to be a business partner and reap some of the upside rewards, think about equity. All right. Now, as we kind of move through like this, these terminologies, another thing that I help investors understand is, are they accredited or not? Do they qualify as an accredited investor? Now, accredited investor doesn't mean that somebody has passed the test necessarily and that they are, all good and they know everything about real estate investing and there's no way they would ever lose money. No, the accredited definition, or excuse me, the accredited investor definition is actually a definition by the Securities and Exchange Commission, and they define it as someone that has earned income of exceeding $200,000 individually or $300,000 with a spouse or spousal equivalent for each of the prior 2 years or reasonable expectations going forward. Or they meet a net worth test of having over $1 million, either alone or together with a spouse or spousal equivalent, okay, outside of the primary house. So if you own your own home, you can't use that equity in that house to qualify for the million. Right? So those are generally the two ways that you can qualify to be an accredited investor, the income test or the net worth test. It's either or. Now, some people don't meet either one of those, but they have a Series 7, 64, 82 license, meaning they're already in the investment industry somehow. And if they have one of those licenses that are in good standing, meaning you kind of gotten the college education as an investor, and I use that in quotes, guys, if you're not watching the YouTube video, okay, you've taken the certificate in the course and the education for this. That's another way that you can qualify to be an accredited investor. Now, here's the thing. Just because you're an accredited investor doesn't mean that you know exactly what you're doing. So that's why we do this webinar series, the Passive Investing Made Simple Masterclass, to help people learn the ins and outs of passive real estate so you can go into that next deal with confidence. As an accredited investor, if you're investing with an operator that only works with accredited investors, you're going to have to provide a letter to prove that you either meet this income test, net worth test, or this licensure test. Now, what happens if you're not an accredited investor? Okay, do you fit the definition of a sophisticated investor? Now, here's the thing. There's no real textbook definition of a sophisticated investor. There's kind of a loose definition, all right? But there's, you're not having to provide a letter stating necessarily, yep, I'm sophisticated, I know what I'm doing, I just don't meet the income or net worth test. But a sophisticated investor is someone generally that has a higher net worth and extensive knowledge and experience in business and investment, okay? Particularly real estate, right? They're also consider to have financial expertise and understand the risk and value of the investment. So the operator that they're investing with kind of feels like, hey, okay, if I brought them into my investment, if I'm able in my investment to work with a sophisticated investor, do I feel pretty assured that they know what they're doing? Now, if you go into a deal that does allow sophisticated investors, you could be expected to sign some sort of legal document stating that you have sufficient knowledge to evaluate the risk and the rewards of the investment. Okay, so you should understand that. All right, we've gone through like what passive income is, what does it mean to invest in a syndication. Are you going to be on the active or passive side? What is the relationship here? Like the general partner, the limited partner. We've gone through, some understanding of what a accredited investor is. Another term that I want to help people understand, again, this is basic lingo. We're not going to get into the math lingo today on today's masterclass, but what is an offering memorandum? Okay, an offering memorandum is a document. It's generally more like a marketing document that states the objectives, the risks, and the terms of the investment. Okay, so this is like for most operators, they're going to put out a nice, beautiful marketed, PDF, with some pictures of the investment and, financial information, biographies of the investment team. They're going to put together the business plan and they're going to describe what their pro forma is or what their plan is for this particular asset that you might be reviewing. Now, keep in mind, this is generally a marketing document, okay? So you want to trust and verify all the information in that document. Then we've got the PPM package, or the private placement memorandum package. Now, if you're watching the video, you see that I have this PPM in quotes because we oftentimes refer to this legal package as the PPM, but really this package is actually 3 different documents. Okay, we've got the subscription agreement, the operating agreement, and then the private placement memorandum. So the subscription agreement, the first document that's generally in there, outlines the terms, the conditions, the commitments of the private placement investment, including the investor amount, who the investor is, what is their accredited status, and any transfer restrictions in the shares of their investment in the business. The next document is generally the operating agreement. Okay, this outlines the terms of the partnership between GPs, the general partners, and the limited partners, including the profit distribution and decision-making decisions and the like. Then you get to the private placement memorandum, which outlines the various terms, risks, and objectives of the investment. Oftentimes attached to the private placement memorandum portion of the legal package is going to be that offering memorandum, that original marketing document that you had as an investor reviewed. Okay, so that should be kind of slid into this paperwork. Okay, that way we all know at the time that you wired your money to the operator, this was all the information you were looking at in order to assess, is the investment appropriate for you or not? Now, I want to make sure that if you're here watching the video, or if you want to go, if you're listening to the audio, go back and find the video on our YouTube page. I wanted to draw the differences between the offering memorandum and private placement memorandum, because sometimes when I'm talking to investors, they review the offering memorandum and then they just quickly sign the private placement memorandum package, but they are really 2 different documents. So I want you to know where you could be looking for certain types of information. So the offering memorandum is going to give you that marketing overview of the investment, the property details, the strategy, visual representation of the business plan, comparable analyses, maybe some economic demographic trends of the market that you're investing in, maybe even include you into some local or community impact. All right, they should also, in the operating memorandum, the operator should have a visual representation of financial projections and a summation of what the future business plan is for the asset. Now, in the private placement memorandum, remember, this is more kind of the legal documentations. We're defining the relationship between the limited partner and the general partner. So the offering memorandum is about hey, here's the investment, here's the business plan, here's the pro forma, this is what we plan to do. The private placement memorandum package is defining, the actual investment. So it has the legal disclosures, all the risk factors, securities law compliance, subscription agreement, investor qualification documents, investors' rights, their obligations, legal disclaimers, regulatory filings and compliance, as well as any legal contact information. All right, guys, we covered quite a bit today. If you're here live, we're about to start our Ask Me Anything part of the show. If you are catching up with us after the fact, be sure to tune in 2 weeks when we go over the math lingo related to passive investments. In the meantime, this is your call to action. Join us at passiveinvestingwithwhitney.com and join our passive investing club. If you're here live, don't go anywhere.